Hello, welcome to today's show. This is Lowcountry Money Talk, and we're always joined by our expert and friend in the business, of course, Phil Bloyd, who's here today from Revolutionary Financial Group to help us navigate what's going on. Nice to see you.
Sure, good to be here again.
You know, one of the ways that we like to kick off this show, Phil, is just really kind of getting back connected with what's going on right now. And it's not always pretty, but sort of painting the picture of what's happening and how is this month shaping up.
Not to be negative, but you know, we need to understand, Jessa, where we're at, first of all, so that we can make adjustments. If we just kind of sugarcoat everything, maybe that's not doing a great service to the audience. So let's take a look at what's going on today as we sit here.
Okay.
So, inflation.
Yes.
Let's start with that.
What's it looking like?
Well, you know, as we watch different media shows, you know, you've been hearing for months, well, it looks like this month inflation is kind of, you know, tapered off or capped out, but that's not the case. So we went up again. So we're at 9.1% inflation. Easily to determine, see how much you're spending, look at your checkbook, how much are you paying for groceries. You know, we got a little break in gas prices, right?
Yeah.
But if I was paying $10 a gallon, it went to $8, but it used to be $2, I wouldn't be too excited.
It's so funny how that perception does change our mindsets. So, you know, if you would have told me 2 or 3 years ago that we would be paying what we're paying for gas, I would have been shocked, right? And now with a little bit of a dip, we sort of feel like, okay, maybe things are going in the right direction.
Your friend calls you, hey, it's $3.79 over here. What a great deal. Come and get some. And you're like, $3.79? It was like $2, you know? So, perception.
Yes.
I would tell people don't get used to a new reality. So, you know, always push for something better. But the inflation, that's something. Now, we did also get a notice on the recessionary numbers.
Yeah, and so, okay, we were talking about this in the previous show about what would happen if, of course, we did have a second negative quarter, and we did.
We did. And, you know, a lot of people were saying, well, that's not going to happen. And it's not just average folks or whatever. I was seeing large bank CEOs on financial shows saying, well, we're expecting a recession the first quarter of next year and this and that. Well, they all backtrack, but these people have access to the best data, the best analysts, and they got it wrong.
That's what's so fascinating really about talking through some of these things is it just seems like people are not able to predict right now because you hear all of these different, you know, determinations about what could happen, what this means, and then it happens and everyone's sort of wrong.
And it's funny, they're like, oh yeah, I said that. I'm like, no.
Right.
My memory is a little bit longer than 10 minutes.
Check the tape.
I'm pretty sure you did not say that. So that's an issue. Now, of course, we're in a political season. We've got midterm elections coming in November. So the government doesn't want to go with a typical definition of a recession over my lifetime, which has been 2 back-to-back negative GDP quarters. But you can look at other things, like we have an inverse in the yield curve. So on the U.S. Treasuries, the 2-year Treasury is paying a higher interest rate than the 10-year Treasury. So that's called a yield curve. That's also an indicator of, guess what? A recession. We have I think it was Ford laid off 8,000 employees. So the tech companies are laying off employees. So what what we're being fed is, well, we have a strong job market. And so we're not in a recession because we haven't had those high unemployment. But it seems to me for the last year we've had 11 million job openings and nobody's filling them.
Yeah, and that's a whole nother problem, right?
I don't know that that's a strong job market if people aren't working.
Right. Yeah, so it is interesting. It seems like all signs point to recession, why we're afraid to use the R word.
Yeah.
Well,
we have to admit we have a problem so that we can start fixing the problem. We can plan for the problem. We can arrange our finances for the problem.
Well, and that's a perfect segue for us going to break because that's what we're going to do for you today in the show. Well, Phil really is going to help us with that, but I'm going to learn, and I hope you do too, so stick around. Welcome back in. If you're just tuning in, this is Lowcountry Money Talk, and we are talking a little bit about current events and how things are going. Phil Bloyd is here, of course, to help us walk through some of this. And it's nice to have you back.
All right, I'm here. Let's get down to it.
It's time to buckle up. We're going to get really down to brass tacks here, because we talked a little bit about how things are going and what this might mean, but we're also going to talk a little bit about really, you know, the bear market, what history has shown us, what we can stand to learn, and how things have been the last couple of months. So I guess let's start there.
Let's do it. So as an investor, it's important to know where we're at so that we can position, you know, for future ups or downs or whatever it may be. I work mainly with retirees and soon to be retirees, more so retirees. So, you know, retirees are special because they have to take mandatory distributions, many of them at age 72. So if they don't have their assets properly placed, they may be selling assets at a much lower rate to take mandatory distributions.
Right.
Which means if the market turns around, they don't have the investments to come back with it. So that can deplete their savings much faster. So the first thing I'd like to talk about, Jessa, is, you know, where we're at in the history of bear markets.
Okay.
So if we look at the Standard & Poor's 500 performance on charts from 1929 to 2020, what has been noted is that there's a bear market about every 5 years or so. Okay, so in a bear market, typically that index will go down about 39%. And as we sit here today, I believe it's down about 16 or 17. For the year, I think the most that it's been down is 22 or 23. Now the NASDAQ index has been down over 30%. And as we sit here today, I believe it's 23%. So the average decline is 39% on the Standard & Poor's, and we're at 17.
So history shows us likely we haven't hit bottom.
Maybe not. You know, it's always hard to call.
Yeah.
What's the fancy word they use for the bottom is capitulation.
Oh.
You ever heard that one? Transitory inflation.
Yeah, right. All these great words thrown around.
So who knows when that will be or whatever, but in the course of a bear market, you have rallies inside the bear market. So I think to this point we've had about 4 rallies since we've been in that bear market. So in July we had a rally within the bear market.
Right.
So to remind our viewers, a bear market is defined as being 20% off the highs.
Yes.
And to get out of the bear market, guess what? We had to be 20% off the lows. Yeah. So pretty simple. No,
I was gonna guess, but I was
no
nervous.
rocket science there. Right. So, you know, history would say that we've got a ways to go.
Yes.
So just as the gas prices pull back a little bit, we have a rally in July in the market. I believe the market in July was up 10%. In June, it was down 10%.
Right.
So that means you're not really even 10%. Oh, I was down 10%, I'm up 10%, I'm even. No. I had $1 million, I'm down 10%, I lost 100,000.
Okay.
I got a 10% return on 900,000, I'm back to 990, not $1 million.
So you're still down.
Still down, okay.
But we're feeling a little bit good.
We feel good because the momentum shifted, but will we be able to maintain?
Yeah.
So what I would tell the viewers to do is now would be a great time to look at your portfolio since we've had that bump and make sure that you have the right amount at risk in comparison to the right amount that's not at risk based upon your age.
Well, that's one of the things that, you know, is so evident about discussing this with you, these trends and how things are going right now, is that there is something you can do about it. You don't just sit around and watch it happen, right? And you really need to dive in and make sure that your assets are in the proper locations. So you all can help us with that, actually. Rachel over at Revolutionary Financial Group can help you set up an assessment and a portfolio analysis so that you do know where you're at right now, so you can make those adjustments. So we need to make sure we're doing that. We got a lot more to talk about. We're going to do that after the break and really kind of dive more into bear markets and, you know, what you can do to plan for retirement or what you can do if you are in retirement. So some heavy hitting stuff.
Got to do it.
Coming up after the break. Stick around. If you're wondering what the financial picture looks like, we've got you covered. We're talking about that today, and this is Lowcountry Money Talk. Phil Bloyd is walking us through it. And we talked about some current events. We talked a little bit about the history of a bear market. We're going to talk a little bit about whether or not it's time for a recheck. You may need to take a look at your portfolio. We're going to keep going on some of the history, though.
Right.
We have more to talk
Yeah,
about.
maybe we're just getting the party started here. So,
We are.
you know, the average duration of a bear market since 1929 is about 1.4 years. And it takes just under 5 years to break even.
Wow.
Now, that's a big issue with retirees.
Yeah, if you have time for that bounce back, maybe not so concerning. But if you're in retirement or about to retire,
Sure.
it's a tougher picture. So walk us through that.
Sure. So, Jessa, let's say I'm still working. Okay. I am.
I think you are.
You are.
We are.
Okay. So, if we're averaging our savings, 401k, so let's say we're being paid twice a month. So when the market's down 10%, I have some money go into investments then, and when the market's up 10%, maybe I have some going there. So I'm kind of dollar cost averaging into the market.
Okay.
Now let's say I'm 70 years old, I'm not working anymore, there's no more contributions into 401k. So if I go down 10%, all of my savings, if I'm invested aggressively, they go down 10%.
Right.
I don't have any more going in.
Right.
So I'm hoping they come up 10%. But if, as my last example, if we go down 10% and come up 10%, it still doesn't make me even, right?
Right.
So I'm going to add one other kink here. So I have to, let's say I'm over 72, I have to do required minimum distribution by the government. If I don't take my required minimum distribution, the penalty is, guess what?
It's a fee. It's a fine.
50%.
Wow. Yeah.
So let's say my required minimum distribution was $50,000. Now I have some retirees that have to take a lot more than that. They may have to take $100,000 a year. So let's just say the example, $50,000. I miss my required minimum distribution. The penalty is 50%. That is $25,000. That is a hard lesson.
That's a tough lesson to learn there.
Let me tell you.
Right.
So I always tell people, you're only going to do that once. Okay?
Yeah, that's the truth. Yes.
Because you'll start calling me in January. Oh, I want to make sure I don't miss my distribution.
Yeah.
But we help people with that to ensure that. So that's something. If the market's down and I'm kind of waiting, I'm getting towards the end of the year. As we sit here, as I mentioned, we have the S&P's down about 17, the NASDAQ's down over 20. So let's say an average of 20. So I'm like, I haven't taken my distribution yet. I'm gonna wait it out. So I'm hoping by November or December things change around.
Right.
If they don't,
Then what?
I still have to take my
You have
distribution.
to take it anyways, right? So.
And people say, well, Phil, that's okay because I'm going to reinvest it. I'm like, okay, you're going to reinvest it, but it's going to be another 20% lighter because you're withholding taxes. And then you can reinvest it.
Okay.
So.
All right, so let's
lesson.
bring this back. Yeah, let's bring this back to the positive before we head to break here. So what do we do, right? So how do we be proactive? How do we, if we're in retirement, nearing retirement, how do we really manage our financial plan to avoid, having to take penalties, having to take distributions in the worst downturns?
The best thing we can do is make sure that as we age, as we get closer to retirement and into retirement, that we're not overly aggressive with our investments.
Okay.
And that means that maybe I'm not investing in growth items or equities or whatever they may. Maybe I pull that risk factor down a lot just to make sure, because remember the data was saying every 5 years, so we have to be careful with that, because as we age, I'm 80. Let's say I'm 80. I know I look good for 80.
You look good for 80.
If I'm 80, the male life expectancy is 79, and I'm in a bear market, and I'm like, okay, I'm 5 years out.
Yeah.
See, the math starts hurting us a bit there, right?
Yep, absolutely. Okay, well, let's, when we get back from break, really kind of bring it together for everybody and talk a little bit about how to navigate this. If you are in retirement, nearing retirement, you always are talking about being proactive instead of reactive. And I think that's really the key for anything that we're discussing here is we can plan for it, and you all can help us with that. So hang tight, we're going to be right back. All right, we have entered into our final segment of the day here on Lowcountry Money Talk. And I think one of my favorite things about the final segment, Phil, is we wrap it all up, we put a nice little bow on it, and we actually give some action plans.
Sure.
And that's what you help us with. So we've been talking about the bear market, current events, really looking at historical data to help us sort of look ahead.
Right.
And what we want to talk to our viewers about now is really how to plan for retirement, if you're in retirement, if you're nearing retirement. So let's discuss that.
Okay. First of all.
Yeah, if someone comes to you, what do you do? What factors do you look at?
Well, I figure they come to me for a reason.
Yeah.
You know, a lot, either they're kicking the tires or they really have problems. Lately, it's been that they really have problems.
It has been.
Unfortunately.
Yeah.
So, the first thing we want to do is I want to, because they may know what's going on and they've been working with this plan or advisor for 20 years, but I haven't. So the first thing I do is I look at their statement. I always say, bring me your statement. So some people bring in an Excel spreadsheet and I'm like, that's not a statement.
Right.
And they're like, well, I don't know you. I'm not going to show you anything. I'm like, okay. If you go to the doctor for a physical or something, they're going to want to look you over.
Right.
Okay.
When you bring that car in, you got to open the hood.
Got to open the hood.
Yes.
So you really need to bring in a statement. If you don't, that's probably it. We're done. Okay. Because I'm very busy these days, of course. And I feel really obligated to my clients.
Yes.
So I need to make sure that I have plenty of time for them. So when we're looking at potentially a new client, you know, it has to be efficient for us, for me and my team.
Right.
So you bring us that statement, easy to do. We see all the positions you hold. You know, you can black out your account number, it doesn't matter. I just need to see the statement so I can see the positions. They will run an analysis of all your positions and then I'll have a report for you. So this is where you are.
Right, and that's, you know, part of the battle is just really understanding where are we right now.
How did you get there? Okay.
There's a question.
So that's the next thing. People were like, well, here's where I'm at. And I'm like, okay, so here's what's causing us problems here. So you went to that doctor's office, they got all the blood work back, all the test results back, and they're like, well, here's where your problems are here. You're gonna you got some issues with your low and high cholesterol ratio, you got this and that, you know, so they're gonna lay out all your problems. That's what I'm gonna do. Well, how did you get here? Well, maybe it was lifestyle or something. I'm talking on the doctor visit. So you gotta change some things.
Yeah.
If you don't change some things, these results are going to come back in even worse next time, more than likely. So it surprises me how often people come to me and I point out their problems, but they resist the change. And I'm like, well, hey, you know, you came to me because inside you knew you had some problems. I highlighted and showed you these problems. Could be low returns, high expenses, whatever it may be. I identified those, and then in most cases, a lot of people say, okay, what's the next step? Well, the next step is we have to have a series of meetings to determine your needs.
Right.
What do you need your financial plan to do? Okay, so we don't want to make the same mistakes we made in the past.
Well, that's interesting that you say that because you're talking about people being sometimes a little bit resistant to the change, even though we know we need to make the change. I think it can be a little bit nerve-wracking though as you get near retirement and all of a sudden you do really need to make some maybe substantial shifts.
Yeah.
So you come up with a plan for people, and that's the key there is it's a plan. You really help lay out what to do and then help them stick to it.
Right. And there's a resistance to stick to the plan.
Right.
Because every time the wind blows, people, reactive. And it's like, no. So let's say we put together a plan. The market's down 10%. last month or in June. Oh, we need to throw the plan out. You know, you heard the term, don't throw the baby out with the bathwater.
That one I've heard.
Okay. So they're like, oh, we got to change right away. I'm like, no, why would we change when we have a long-term plan? The reason that people typically get in trouble that I see mostly, Jessa, is because they're too aggressive.
Yes.
They think that the good times are here to stay because we've been in a bull market for 13 years or whatever, and I'm always the signal person out there saying, okay, let's put the right percentages at risk because we'll do fine with that. We're not spring chickens anymore, right?
Yeah.
So we're 70, 75, and they're still thinking of their younger years.
Right.
So we have to put the plan together, then we have to follow the plan, which is also can be difficult, but that's what I'm here for.
Yes, well, that's where we need you as financial advisor and planner, and also sometimes therapist, just to keep us from going off the rails in tougher times and stick to the plan. If you want to have Phil and his team take a look at your portfolio to do an analysis, well, sounds like bringing a statement is a good thing to do. Call Rachel, they'll do that for you. If you have $500,000 or more in assets, that would be a good client for this group.
Yes.
Lots of good information.
Good.
Thanks so much.
All right.
Thank you for watching. We'll see you next time on Lowcountry Money Talk.